Private equity, these public markets. Where should you invest now? In today's volatile financial environment, investors are increasingly faced with a fundamental question. Should they put their money in private equity or public markets? Both options offer unique advantages and challenges, and the best choice often depends on individual investment goals, risk tolerance, and market conditions. As economic uncertainty, inflation concerns, and interest rate hikes continue to influence global markets, it's more important than ever to understand the dynamics of these two investment avenues. Understanding the basics. Public markets refer to stock exchanges like the NYSE, NASDAQ, or FTSE, where shares of publicly listed companies are traded. These markets are transparent, liquid, and regulated, making them easily accessible to individual and institutional investors alike. You can buy or sell stocks in real time with minimal friction. Private equity, PE, on the other hand, involves investing in private companies that are not listed on public exchanges. This can be done through venture capital, growth equity, or buyouts. Private equity is typically dominated by institutional investors or high net worth individuals due to high capital requirements and long lock-in periods. Performance comparison. Historically, private equity has often outperformed public markets over the long term. According to data from Cambridge Associates and Prekin, top-tier private equity funds have delivered internal rates of return, IRRs, in the mid to high teens, sometimes even higher. Public equity markets, such as the S&P 500, have returned an average of about 8 to 10% annually over the last several decades. However, this outperformance comes at a cost. Private equity investments are illiquid and can tie up capital for 7 to 10 years. Unlike public stocks, they cannot be easily sold on an exchange. This illiquidity premium is part of what drives higher returns, but it also increases risk and volatility. Public markets are subject to daily fluctuations driven by news, macroeconomic data, and investor sentiment. This constant visibility can cause panic selling or emotional decisions, especially during downturns like the 2020 COVID crash or the 2022 bear market. Private equity, while not immune to economic shocks, is insulated from daily market swings. Because valuations are updated less frequently, there's less visible volatility. This doesn't mean the underlying value is more stable, just that it's measured differently. Still, this long-term focus can be a psychological advantage, keeping investors more disciplined. Liquidity, a critical factor. One of the most important distinctions between the two is liquidity. Public markets allow investors to buy and sell quickly, often within seconds. This flexibility is ideal for those who may need access to cash on short notice. Private equity, conversely, locks investors in for years. Funds have specific life cycles, and early exits are rarely possible without penalties or significant losses. This makes PE better suited for long-term investors who can afford to forego liquidity in exchange for potentially higher returns. Transparency and regulation. Public companies are required to publish quarterly earnings, file disclosures with regulatory bodies like the SEC, and undergo audits. This transparency allows investors to make informed decisions based on data and performance metrics. Private companies, by contrast, are not subject to the same scrutiny. While private equity firms perform their due diligence, investors often have limited visibility into day-to-day operations or financials. This opacity can pose a risk, especially for less experienced investors. Fees and costs. Another key difference is the cost of investing. Public market investing, particularly through index funds or ETFs, can be extremely cost-effective. Many ETFs charge management fees of less than 0.1%. Private equity, however, is known for its high fees. The traditional model, 2 and 20, means a 2% management fee annually plus 20% of profits, carried interest. While these fees can be justified by outperformance, they also eat into investor returns, especially when performance lags. Access and inclusion. Until recently, private equity was the domain of the ultra-wealthy. However, that is beginning to change. Platforms like Moonfare, Fundrise, and Yield Street are democratizing access to private markets, allowing individuals to invest with smaller minimums, sometimes as low as $5,000. Still, public markets remain far more accessible, with retail investors able to buy fractional shares of companies through apps like Robinhood or Fidelity. Macroeconomic Trends in 2025. The current global economic landscape plays a significant role in choosing where to invest. As of 2025, we are witnessing slowing GDP growth, ongoing inflationary pressure, and elevated interest rates in major economies. These factors have made public markets more volatile and have dampened returns. Private equity, in contrast, may benefit from this environment. As valuations in the private markets adjust to reflect economic realities, PE firms are finding attractive opportunities to acquire distressed or undervalued assets. Moreover, many private equity firms have significant dry powder, uninvested capital, ready to deploy, giving them an edge in tough markets. That said, rising interest rates also affect private equity negatively by increasing the cost of leveraged buyouts, a common strategy in PE. This may squeeze future returns or lead to more conservative deal-making. Which one is right for you? Public markets are ideal if you need liquidity or may want to access your funds within a short period, prefer transparency, lower fees, and real-time access to financial data, are comfortable with short-term volatility, want to diversify through ETFs or mutual funds. Private equity is better if you can commit capital for 7 to 10 years without needing liquidity. They are seeking higher long-term returns and are willing to accept higher risk, have access to high-quality private equity opportunities or platforms, are looking to diversify away from traditional stock and bond markets. A blended approach. For many investors, the smartest strategy isn't choosing one over the other, but combining both. A diversified portfolio that includes both public and private assets can offer a balanced mix of growth, stability, and income. By allocating a portion to private equity, investors may benefit from long-term outperformance while retaining flexibility and liquidity through public markets. Financial advisors often recommend that accredited investors allocate 10 to 20% of their portfolio to alternative assets, including private equity, depending on their risk tolerance and financial goals. Both private equity and public markets offer compelling investment opportunities, but they serve different purposes in a well-rounded portfolio. In the uncertain climate of 2025, where traditional market signals are becoming harder to read, private equity presents a strong case for those seeking long-term, potentially outsized returns. At the same time, the liquidity, accessibility, and lower fees of public markets remain attractive for many investors. Ultimately, the best path forward is guided by your personal financial situation, goals, and risk appetite. Consulting with a trusted financial advisor can help you determine the right balance between private equity and public markets and ensure your investment strategy is resilient no matter what the future holds. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.